now recording on here. We've got our 2 slides going. Now let me maximize this. And of course it's not doing that. Bear with me for a second. I don't know why this isn't working. Okay, there we go. Okay, so the next chapter is on raising capital. And I don't know if it's in the current text anymore, but this chapter used to begin with a discussion on Visa's IPO, which was at the time the largest initial public offering, which is IPO, of all time. And I think that they started out when they were initially priced at $44 a share. And Facebook recently went public. I don't know if you recall back to that, if you were following finance at all at the time. But that was a huge endeavor. And in fact, there's been a couple of them recently. You know, wasn't Twitter a few years ago? Did LinkedIn go public? I think that they either have or they were considering it. So there's been a variety of these IPOs that have gone public recently. Facebook was the 3rd largest IPO ever at $38 per share. And I don't know if you recall that, but it was like a big, big endeavor when that happened because a lot of people thought they were overpriced at $38 a share. And because the stock price immediately started to decline right after the IPO went forward. So what the IPO is really is the starting price of the stock. And we're going to talk a little bit about how that actually occurs in this chapter. So this chapter is about how you can get money. And we'll talk a little bit more about these IPOs, and we'll talk about other forms of financing as well. So here's some of the key concepts and skills for this chapter. We're gonna want to understand venture capital and its role in financing businesses. We'll talk about how securities are bought and sold to the public and the role of investment bankers, and we'll discuss initial public offerings and the cost of going public. Chapter outline looks like this. The first thing that we're going to discuss is the financing life cycle of a firm. We'll talk about early stage financing and venture capital. We'll talk about selling securities to the public, the basic procedure. We'll discuss alternative issues. We'll discuss underwriting. We'll talk about IPOs and underpricing. We'll talk about new equity sales and the value of the firm, the cost of issuing securities. Briefly talk about long-term debt and shelf registration as we close the chapter. Okay, so let's start off by talking a little bit about venture capital. You guys have all heard of venture capital, right? We're all familiar with Shark Tank now, so that's basically a form of it. Private equity is another term for this, and this is the private financing for new high-risk businesses in exchange for stock. Here you're going to have individual investors or venture capital firms engaged in trying to get a part of your idea. You know what I think is important to mention nowadays, there's even new types of ways to establish capital that aren't even discussed in the textbooks yet with crowdfunding. And crowdfunding is pretty much popping up for everything. You know, you can obtain money for, I just saw the other day, for, you know, from a professor standpoint, you know, research, you could go on and try to, obtain money for a research idea. I don't remember the name of the crowdfunding website for that, but there's crowdfunding for everything. You know, bands get crowdfunding so that they can make CDs. Artists get crowdfunding to do certain artwork and so on and so forth. And businesses are doing this as well to kind of launch startups. So it's not just private equity, but private equity is probably kind of what you're trying to mimic with crowdfunding. So it usually involves active participation by venture capitalists, and the ultimate goal for under venture capital is to take the company public. And the venture capital will benefit from the company or from the capital raised in the IPO. Some of the issues involved with this are that it's hard to find and it can be expensive. In other words, you guys have seen Shark Tank before. You might give away a large percentage of your organization in order to kind of get that boost. And that can be, at the end of the day, very expensive when you're giving away large percentages of your organization at the blink of an eye. So let's talk about some of the stages involved with venture capital. Funding is typically provided in various stages, and it's contingent upon specified goals at each stage. The first stage is considered by some to be the quote ground floor, or where you have your seed money. And here's where you're kind of, they use the example more of a manufacturing situation here, where they're saying you fund your prototype and manufacturing plan. And as you can see, when you watch Shark Tank or a show like that, they tend to be manufacturing ideas. You know what I mean? So the second stage involved would be a mezzanine financing, which you can imagine kind of another layer up. The ground floor is down here, and then you have a mezzanine financing where you begin the manufacturing, marketing, and distribution. I don't know. Has anybody gotten involved in anything like this? I really think that you learn a lot actually about this process from the crowdsourcing stuff like Kickstarter. And has anybody tried any of those, either to do a project or to just look at it? Have you ever looked at it? I invested in one. I'm into vinyl records, which is kind of weird. You're probably like, what's wrong with this guy? But they're making a comeback, and
they're valuable.
They are, and they're honestly, for like audiophile type people, they're the best form of actually getting high quality music. It's still vinyl records, believe it or not. Anyway, there's not I don't know if you've ever looked for a vinyl record player before, but there's not good ones in a low cost. It's your Crosley or your got like, they're not very good. Anyway, there's an organization out there called Orbit that we're basically trying to create high level, but reasonably priced vinyl record players, and I invested in them. But it was really cool. You got to basically see their product. They would put up videos. You get stuff back for investing in them, and then when they finally get to the point where they're manufacturing, you get one of the record players. So it's kind of neat to do that. So you should take a look at that at some point. I think it's worth it. All right, so choosing a venture capitalist. There's various things that you should consider. One is the financial strength. You should take into account the individual or the firm's resources. Do they have a lot of resources behind them? When you watch that Shark Tank thing, that's one of the things that I constantly think about is the relative resources that each of those 5 players have. I feel like Mark Cuban's just probably got endless supply of money in his pocket, whereas I feel like he can outbid the rest of the guys on there. So that's one element. Another thing is a compatible management style. How involved will the person be within your work? A third thing, obtain and check references. Of course, you should do something like that. You should think about their contacts. Do they have a lot of contacts? And it's another thing, on that show, you can see that, if somebody comes to the table with a certain idea, they want to know, one of the major players may be more connected in that area, and therefore they might decide to go with them. So that's an issue as well. And then finally, an exit strategy is important too when you're talking about anything that has to do with money. So you should also be considering the exit strategy. As far as when they close up shop, how are they going to how will the venture capitalist itself exit out of the picture? Or alternatively, there's three elements to this. One, how does that venture capitalist exit out of the picture? Two, how are you both going to exit out of the picture if you ever turn it into a public firm? And three, what happens if everything goes negative? That's another exit that you would have to consider is if everything goes down, how are you going to be left? So you'd have to consider all these different elements when choosing a venture capitalist. Where are we here? Okay, so I have a video, and given the fact that we're kind of recording this right now, I don't know if I can show it, so I'm going to leave you guys to watch that at home. There's a video at this point that I typically like to show on which type should sell securities to the public, and it has to do with different venture capitalists and selling securities in general to the public. You can take a look at that at your leisure. It's posted on Moodle. Okay, so jumping right into selling securities to the public, management's going to obtain permission from the board of directors to start this process. If they are going to sell securities to the public, management's going to go to the board of directors and try to obtain some sort of form of permission from them. If they are granted the permission from the board of directors, they're then going to file a registration statement with the SEC. And the SEC, for those of you who aren't familiar with that, that's the Securities Exchange Commission. The Securities Exchange Commission is then going to examine the registration during a 20-day waiting period, and securities may not be sold during the waiting period. So this is the process behind selling securities to the public. The fifth part on here is a preliminary prospectus called a red herring would then be distributed during that waiting period. If problems, the company amends the registration and the waiting period would then begin again. And then finally, the price per share is determined on the effective date of the registration and the selling effort begins. Okay, so I think the book has an example on this. If you do have an opportunity to read through the chapter on WWE, the Wrestling Association, and how they went public. So it's kind of a straight run through the entire process right there. So how do you go? What are the different types of methods involved? Well, there's a public issue or there's a private issue, and there's a huge distinction between the two. With the public issue, there's really two different types. There's a general cash offer, which is offered to the general public, or a rights offer offered to current shareholders. We already mentioned that there's a registration required with the FCC. And then you would have an IPO, which is an initial public offering, and we consider it an unseasoned new issue. An alternative to that is a seasoned equity offering. Now, initial public offering is the first. A seasoned equity offering is kind of, you can think of it like a ladder or secondary type thing. The private issue is different than the public issue. It's sold to fewer than 35 investors, and SEC registration is not required. Okay? So when they say you are going public, the firm is going public, that's what they mean. They mean the public issue. Private issue is another concern altogether. You guys can take a look at, you can dig deeper to check this slide out. This has some information on the different types of public or private offerings and some information associated with each. We're going to skip through that for the sake of time now and move on to the underwriting that would be involved if you do get yourself involved in an IPO. So if there's a public issue and it's a cash offer, underwriters will be involved. Underwriting services will help with the formulation of methods to issue securities. They will help price the securities. They will help sell the securities. And they will help with price stabilization in what's called the aftermarket. So underwriters are the people who are involved in setting the initial price. Remember when I started off the chapter by saying that Facebook started off at $38 a share. And I think they're well above that now. But at the time, people didn't really believe in Facebook. And they were very confused because it's a very different product than anything's ever existed. And they weren't sure where to price it. So the underwriters involved in that set the price at $38, and it started going down once it reached the market. So therefore, the underwriters were to blame, or at least blamed heavily in that circumstance. So that's a big deal. The underwriters are involved in basically guessing what the market would value the stock price at. So think of it like something like Vegas setting a line. You know, at first, Vegas puts out a line on a game. You know, like the Super Bowl. They say somebody's going to win by 7. And then what Vegas does is washes its hands of that and then just backs off. And what happens with the line in Vegas is then you have some people betting on the Seahawks, which will change the line towards the Seahawks. And then you have people betting on the Patriots, which will change it back and forth. Same kind of idea, but that initial line is set with, in this case, with the underwriter. They're setting that initial price. And then it'll vary from there.
Is the underwriter normally one of the big banks?
Yeah. Yep. So they're generally heavily involved in this process. We'll go through a couple of them a little later. I think there's a slide on that. So there's a syndicate, which is a group of investment bankers that market the securities and share the risk associated with selling the issue. There's also a spread, which is the difference between what the syndicate pays the company and what the security sells for in the market. So here you have what used to be WWF. I don't know why they changed their name. If anybody's a wrestling fan,
They were sued by the Wildlife.
there you go. So I guess it's now WWE is the symbol for it. But you can see here in this example, investment banks and the syndicate are divided into brackets. So these are these. Bear Stearns you've heard of before, Credit Suisse, Merrill Lynch, and so on. Firms are listed alphabetically within each bracket. There's a pecking order involved. The higher bracket, the greater the prestige. That's referring to this stuff down here. And the underwriting success is built upon reputation. So, you know, it might seem negligible since Facebook's value went up but you know, when you have a big situation like that where the stock price goes down substantially right after the IPO, it's kind of egg on the face of the underwriter. So underwriting success is built upon reputation. You want to have a good reputation for setting the right price and so on and so forth. There's different types of underwriting, and we're now going to go through some of those. The first type of underwriting we're going to talk about is firm commitment underwriting. And here, issuers are going to sell an entire issue to the underwriting syndicate. That syndicate's then going to take and resell the issue to the public. The underwriter is going to be the one who's going to make the money on the spread between the price paid to the issuer and the price received from investors when the stock is sold. So the syndicate is going to bear the risk of not being able to sell the entire issue for more than the cost. And the most common type of underwriting in the United States is this firm commitment underwriting. But there are different types. Another type of underwriting is best efforts underwriting. Here the underwriter is going to make its best effort to sell the securities at an agreed upon offering price. The issuing company bears the risk of the issue not being sold, and the offer may be pulled if not enough interest is available at the offer price. Here the company is not going to get the capital, and they will still have incurred some substantial flotation costs, which we explained earlier are the costs involved in the transaction. And this is not quite as common as it used to be. The final auction that we're going to discuss is the Dutch or uniform price auction, which is an auction that's often discussed in economics classes as well. Here you have buyers who bid a price and a number of shares, and you have a seller who worked down the list of bidders and determine the highest price at which they can sell the desired number of shares. All the successful bidders pay the same price per share, and what this auction does is it encourages aggressive bidding. We'll show you an example of this in just a second. Okay, so here's an example. Say you have a company that wants to sell 1,500 shares of stock, and the firm will sell the 1,500 shares at $15 a share. But how do we get to that number? Okay, let's start off. You can see bidder A wants to is willing to bid $20 for 500. Okay, so they want to get rid of 1,500. 500 is not enough. Okay, but it's a good portion. So 20 times 500. Well, actually, let's not even get into the mathematics of the price yet. If you just take the $500 or 500 in quantity across and move on, you see that company B or bidder B wants to purchase 400 shares at a price of 18. Go down to this level and you say, okay, we have 400 plus the 500 that bidder A wanted, who valued it the highest. That's a total of 900. Then you move down to bidder C, who wants 250 and is willing to pay 16 bucks for it. You add that 250 to 900, and you get up to 1150 total shares. We're still not up to the 1,500 shares that this firm wanted to sell. So we go down to the next guy who's willing to pay the next highest at $15 a share, and he wants to buy 350. At that point, we get to our 1,500. And all those people who valued it higher than 1,500, they get to pay all those people who valued it higher than $15, like person A, person B, person C, and person D valued at $15. They all get it for $15. Okay? So all the above will get the shares, but they will get it at the price of the lowest bidder who makes it past that threshold. Kind of see? Anybody have any questions on the Dutch or uniform price auction? All right, let's keep moving. This is used in a variety of different ways. It's in some ways, this sort of thing was used on eBay and those sorts of auction sites. It's also used in some government. Government uses Dutch and uniform price auctions frequently as well. Okay, some terms to note for this chapter. One is green shoe provision, and this is an over-allotment option. It allows a syndicate to purchase an additional 15% of the issue from the issuer, and it works as a security. It allows the issue to be oversubscribed, provides some protection for the lead underwriter as they perform their price stabilization, and in all IPO and SEO offerings, but it's not an ordinary debt offering. It's not used. The green shoe provision is not used in those circumstances. A lockup agreement is another term to note. It's not legally required, but it's common. It restricts insiders from selling IPO shares for a specified period, and the common lockup period is 180 days. So stock price tends to drop when the lockup period expires due to the market anticipation of additional shares hitting the street. So basically, this is you put into a lockup agreement into an IPO to basically forbid insiders from selling those shares at all for a specified period of time. Okay, so IPO underpricing. The pricing in general of IPOs is really difficult. We kind of already talked about that. If you put the price a little too high, it could be potentially bad. If you put it too low, it could be potentially bad. There's no market available to try to figure out what the right price is. So Dutch auctions are designed to eliminate that first day IPO price jump, or pop as they call it here. Underpricing causes the issuer to leave more money on the table, so that's not necessarily wanted. But the degree of underpricing varies over time. So what are some of the reasons behind underpricing? Underwriters want offerings to sell out, so they might decide to go low with the original price. And because of that, reputation may help because you're actually selling out quickly. Underpricing in that sense can provide an insurance for the underwriters. There's an oversubscription and allotment, and there's something called the winner's curse, which is the thought that bidders will overprice the inherent price no matter what you price it at. So the smaller, riskier IPOs underprice to attract investors. And that's one of the reasons why I use the Facebook example, that overpricing can be such an issue. If you priced it over what the underlying price should have been, it's really bad to see that price sink, sink, and sink. You'd rather go a little lower than what the price would be and see it raise up somewhat. All right, so we talked a lot about IPOs, initial public offerings, and that's for a firm that's just introduced itself to the public. Seasoned equity offerings are something we should discuss as well. This is a situation in which it's kind of being done again, in a sense. So stock prices are going to tend to decline when new equity is issued. There's explanations for this that are related to signaling, which is something we talked about in the last chapter. In some cases, equities might be overvalued. If management believes equity is overvalued, they would choose to issue stock shares. It could be due to debt usage. Issuing stock may indicate the firm has too much debt and cannot issue more debt. It may also, another aspect involved might be issue cost. The issue costs for equity are direct and indirect and can be significantly more than for debt. There's a number of terms here that are described that we may have discussed, like the green shoe option and underpricing, that are described here, and it discusses the cost of issuing securities associated with each. Just to give you a quick example, we have the spread. The spread consists of direct fees paid by the issuer to the underwriting syndicate, and it's the difference between the price the issuer receives and the offer price. You know, a lot of the terms that you see in finance are kind of transferable across finance, and spread is kind of one of them, where you should generally have an idea of what spread means no matter what you're talking about, but it can mean a little bit of a different thing depending on the actual terms you're describing. Let's move on. Okay, so I think your textbook has it as an example. I have written down here, page 187, table 15.4, on the cost of issuing securities. According to this, there's some sort of direct cost of 10.4 associated with this particular table. Let me take a look at it. It's page 187 I have circled here. Has to be the old textbook. 187 makes sense. It's table 15.4. 499. So this is going into why underpricing exists, and let me just check something out real quick. I don't see these numbers matching up. Yeah, this is referring to something I think a little bit different than that table. Anyway, I think they're mentioning that the total direct cost associated with the cost of issuing securities is about 10.4% of the overall cost. The direct costs they see here are relatively large at a little less than $10 million, especially for issues. These would include stuff like filing fees, legal fees, and so on and so forth. The underwriting costs, I don't know if that's mentioned in that table or not. That's the cost of selling below its true value. That's thought to be about 19.3%. And the average spread involved is about 7%. So there's a lot of costs just associated with the cost of issuing the new security. And these refer to kind of along the lines of the flotation costs, the transactional costs that are associated when you do issue the new security. And there's some patterns involved. Economies of scale is something that we talked about in the past. If it's a relatively large firm, it may have lower average costs associated with it. The cost of selling debt will be less than issuing equity under certain situations. IPO costs in general are lower than SEO costs, and straight bonds are going to be less than conventional bonds. Basically, or convertible bonds. A convertible bond price is greater than a straight bond price, and convertible bonds are bonds that can be converted from bonds into stocks. If you haven't heard of these before. Okay, we're briefly going to talk about long-term debt, and then we'll get into one final thing. We'll close out the chapter. So the majority of the chapter so far has been about stocks, has been about IPOs, and has been a little bit about venture capital. Another form in which you could obtain capital is long-term debt. We've talked a lot about this in the bonds chapter. You can have bonds that are public issue forms of long-term debt, but there can also be private issues, such as different types like term loans, where you have a direct business loan from a commercial bank or insurance companies, and these generally have maturities of about 1 to 5 years, and they're repayable during the life of the loan. Private placements are an alternative to that, and similar to term loans with a longer maturity. Why would you go with a private issue? It could be easier to negotiate than public issues, and it could involve lower costs than public issues. And under these circumstances, there's no SEC registration because it's a bond, so that's positive too, because there may be transactional costs associated with that. Okay, we're going to talk a little bit about shelf registration or regulation. SEC Rule 415 was established in 1982, and it allows for shelf registration. And under this, it permits the firm to register large issues with the SEC and sell it in small portions. And this is going to reduce flotation costs. It allows the company to be more flexible. Basically, sometimes market conditions are not favorable for the IPO. And for example, if housing is about to decline, with shelf registration, a company can fill out a registration before and go to the market quick later. So that basically allows you to kind of shelf a project and re-register it later if needed. There are certain requirements for this to occur. The company must be rated investment grade, which we've talked about in the past is quite a limitation because a lot of companies are trying to get their bonds to be investment grade bonds. And remember back to what that actually means. You have to be rated. It depends on what rating agency you're talking about, but in general, you have to be A+. It cannot have defaulted on its debt within the last 3 years. The market value of the stock must be greater than $150 million, and there should be no violations of the Securities Exchange Act of 1934 in the preceding 3 years. That would allow you to go forward with shelf registration where you could reenact an IPO at a later date. Basically shelve it. All right, so we're going to end the chapter there. Next week we're going to do chapter 17, and we're going to do chapter 18, 16, 17, and 18. And once again, for those of you who weren't here earlier, there's an option for extra credit on Moodle, which you can look at. And for those of you who are watching the video at home, the option describes if you're in class next week, you have the opportunity to go through chapter 17, pick out a topic that you find interesting from the chapter. Hopefully you have either professional or personal experience with it. If not, maybe you could find an article that deals somewhat with that topic. And the goal is for you to come to the class, if you can make it to class, and talk about the topic and kind of explain the topic through your own terminology or through your own life experience or through an article. Alternatively, if you can't make it to class, the alternative to that is that you could write a 2-page paper on the subject. So you have 2 options. If you can make it to class next week, fantastic. You come in, you just talk about it. If you can't, you write a paper about it if you're interested. This is completely optional. So if you want to do it, you can. If you don't want to do it, you don't have to. All right, so we're going to end it there. And yep, there's a project due next week, and there's a homework due.
Yeah, I was looking at the homework. I'm sorry.
Mhm.
But it's kind of a lot. Is it calculation or we just have to answer questions? So page 509.
Can I just give me 1 second? I'm going to turn this off so that we're not recording.